Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets where we saw a correction this week. The so-called Magnificent Seven is now down to 2 or 3 at best. He takes a look at gold, which continues to break out, crude, the US dollar, and the struggling Canuck buck. Ross also has a special offer for our listeners. President of Venable Park Investment Council Incorporated, Danielle Park, analyzes the Canadian federal budget. Will Canada have a soft or hard landing? And is there anything in the document that will prod the nation's lagging productivity? Danielle is also worried China's real estate crisis will cross the Pacific. Veteran trader Victor Adair joins us from Vancouver Island. He gives us his take on how the conflict in the Middle East will hit the markets, along with gold, crude, and the US dollar. We'll talk to Ross Clark right after this.
Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclicode.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
Welcome to This Week in Money, the source for market opinions. Here
My guest is
Jim
Ross
Goddard.
Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on X at Charts by Ross. Welcome back to the show.
Always a pleasure, Jim.
Ross, do we have a special deal for our listeners?
Yeah, it's 25% off for new annual subscriptions, and we're into that point of the market where you're getting good solid breaks, and unless somebody wanted to be short in the market and has been sitting with cash, there's going to be some pretty good opportunities coming up here. So this is what we hope people will come along and subscribe for. And we'll give them specific ideas on some of the indices and some of the stocks that might jump out at us as well.
Ross, how would you describe what happened on the stock markets this week?
Would you call this sort of down and dirty? Every morning got started with a bit of an upside and finished off the day on the downside. So this is the classic of a bear market, or at least the early stages of one. We've been looking at and watching this rounding top, and depending upon the indices, they topped either in late February or mid-March. And it's just been an area where the advanced decline lines have been starting to give up the ghost. The sentiment numbers have been in extremes, way too many bulls. Now that's starting to pull back a bit. You've got things like the Dow theory signal, where the Dow industrials were going up and making new highs, but the transports were not confirming that. And so when you get a divergence like that, that's a classic of a high and ready for a correction. The key then to defining whether it's a bear market is if they both take out supporting lows. So after a decent bounce here, if they go back down and take out whatever lows we're putting in right now, that would have a more bearish implication for the intermediate term, rather than just this short-term break we've seen right now. But, you take a look at it, these numbers are pretty significant. You've got, the S&P and down 7% off the highs. You've got NASDAQ down 10%. And things like in the Mag 7, the Magnificent 7, Netflix is down 9% at this point, and NVIDIA, which have been everybody's darling, is down 10% on the week, 21% overall, and it's given back over $200 billion in market cap. So this is what you call a pretty good clean out. So our long-term model, the one that I use, which is goes back 100 years, we were at the top end of the channel. The S&P was up around 5,300 and change. The resistance was going to be 5,400 and up. So, when you've rallied from 10 to 5,400, you're getting up to pretty close. So this correction, and that's at this point, that's what I'm deeming it to be. We are just around 5,000 on the S&P cash, 4,980, and anything around 4,900, I think, should become a pretty reasonable support in here from which to get a bounce. We did get very rare capitulation signals on the S&P as of Thursday and Friday, and all the way back to 1998, there's only 15 of these signals that on our model, and each one of them ended up with either a tested low or a nice run off the bottom. So I think short-term traders, there's some good opportunities probably early next week for a nice bounce, and longer-term traders, we're going to let the market sort of resolve themselves over the next couple of weeks before stepping in a bigger way.
What's going on with gold?
Gold got, with the situation on Thursday night and the Israelis doing an attack into Iran, a limited one. Gold got a big spurt initially and then gave it back, but closing off the week at 23.88 on the cash price, silver around 28.66. So they both had pretty much a flat week, but considering the extent of the gains that we've seen here, doing an excellent job of consolidating. And, I would think at this point, there's, still probably a reasonable chance of a small pullback, but overall, uptrend is still nicely in motion. And, you take a look at the miners, they held in here pretty well as well. So, enjoy the sector right now because the money, is looking for a place to go. It's the rotation out of the high-flying tech stocks is changing. We definitely have seen the miners and the base metal stocks do nicely coming out of their bottoms here. Probably due for a small consolidation in there and then continuing on in the upside.
What's happening in the crude market?
Crude, I expected that we might have lasted another week or two on the upside, but it definitely has run out of steam. Got the little pop on Thursday night. We rallied from, $82 up to $85 in very, very short order, but back to $82 at the end of the week. And this is starting to look tired at this point. I think that $82 level that we saw on the low this week is probably the key level to be watching for. Seasonally, the run from the double bottom in December, January was a pretty good move, and it's due for a fairly long consolidation, and let's see if it can hold that $82 level.
What's happening with the U.S. and Canadian dollars?
The U.S. dollar ended up the week at just over 106. Been just like we saw in the precious metals, a quieter week. We've been, I guess, at 106 plus or minus a few ticks here since a week ago Friday. The trend there has got some pretty good resistance from here to 107. So we'll see how it does at that point. Canadian dollar is in trouble as far as I'm concerned. We take a look at it relative to what we've been seeing in the commodity prices. You'd expect that the Canadians should have done better in this last few weeks. and all you've had is a very, very small bounce this week. We did have a nice oversold reading 6 or 7 days ago, but the rally is probably going to have a lot of difficulty in the 73 and a quarter range. We're at 72.70 right now, and we are just still teasing that multi-year low, which was down at 72 and a quarter. Wouldn't be at all surprised that gets taken out in the not too distant future.
Ross, thank you so much for being on the show.
It's been a pleasure, Jim.
My guest has been Ross Clark from chartsandmarkets.com. Find him on X at Charts by Ross. Coming up, Danielle Park, next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Her websites, jugglingdynamite.com and venablepark.com. Danielle, welcome back to This Week in Money.
Thank you, Jim.
This week, the Canadian federal budget was dropped. A section in the budget was titled Canadian Economic Outlook. Private sector economists expect a soft landing. Could inflation and interest rates turn the hope for soft landing into a hard landing?
Yeah, well, sure. I mean, I chuckled a bit when I read that because basically that's all of the senior economists from the big banks, and their consensus is always for a soft landing, no matter what, right? They never call for a recession. So the government was just parroting what the consensus always says. But the thing, I guess, that really is most instructive is that coming this normalization of interest rates, which, let's face it, this has been a normalization of interest rates. It's not that interest rates are obscenely high, it's that they were obscenely low for a good period of time thanks to fiscal and monetary policies that were geared at keeping them really low. So now they've come back up to where they were in 2007 in terms of the policy rates. But again, that's sort of the average range, not extremely high. We're not talking 1980-style interest rates here. But the point is that coming as they did after years of debt-fueled consumption and over-allocation to things like housing, making it more expensive, fancier, bigger, but less efficient, and driving the household debt sector to record highs, particularly in Canada, that means that the normalization of interest rates is really hitting this time harder than it would have otherwise. And not only that, but as I've mentioned many times, there is this lag of up to 24 months from the time that policy rates are changed and that filtering through the general economy. So if you think about it, yes, central banks have been on hold since July of 23 in North America, but actually the hikes that they implemented up until last July will still be working through the economy for another year. More than that, actually, out to even July of 25. So that really tells you that we can't call all clear yet, and even the government, their base case consensus that they used in this budget was for GDP growth of 0.7% in 24, Jim, and 1.9% in 25. Well, obviously that's extremely weak by historical standards. That's barely beating, so to speak. And that means that we are extra vulnerable when your growth is that, modest or flat. Any kind of shock, including this, as I say, larger impacts working through from the tightening cycle that's already happened, that kind of thing can really surprise to the downside. And the government's own forecast for unemployment in Canada is that it rises to 6.5% by the end of this year. And that's in this, as I say, flat kind of growth environment with no recession priced in. We've never seen a rise of more than 80 basis points from the cycle low without being in a recession in Canada. And the cycle low this time was actually 4.8% of unemployment in July of 2022. So when they're saying they see this, unemployment continuing to rise, as it has been stepping up now since July of 2022, they see it continuing to rise through the end of the year. And then I would point out that once unemployment is rising, it typically does so throughout the Fed cutting cycle. So once the Bank of Canada, right now the expectation is they will start to cut interest rates later in 2024, and 1 to 2 cuts is the base case at the moment that's priced into the bond market. But basically, once they do start cutting, they tend to go for multiple quarters after that in a cutting cycle, and during that time it is typical for unemployment to continue to rise month after month. And even once they're done cutting and we start to see the economy turn around in terms of GDP growth, you still see companies shedding labor because typically they're quite stressed from the downturn in revenue that they've just been through. So it's important to keep in mind that the soft landing is the base consumption of all, the base consensus view at all times, but it's really too early to be calling the all clear here, as I said. And the other major issue, of course, is that government spending and fiscal transfers. So this is, the government is having deficit spending here. They're expecting to have a deficit of about $40 billion. Certainly the United States has had massive deficit spending. And to the extent that that goes into funds, that it allows consumption in the economy and more housing consumption and speculation, then it's really working at cross purposes to the monetary policy in the country. So the Bank of Canada is trying to not increase rates more, and the banks and many sectors of the economy are begging the central bank to start easing policy to cut interest rates. At the same time, they're constrained by this trying to stay in this 1 to 3% inflation range. And to the extent that fiscal spending keeps boosting consumption or boosting spending, boosting GDP, then really they are making it harder and harder for the central banks to ease in terms of their policy rates. And that's really compounding now because the longer they're staying at, as I say, the high of rates that they are presently, we're already seeing this, major acceleration in insolvency filings, bankruptcy trends, all this kind of downstream effects that are coming from keeping policy the tightest it's been in about 17 years. So it'll be very interesting to see, again, if the central banks want to start easing, they're going to be constrained to a large degree by the amount of fiscal spending that keeps stimulating on the consumption side.
Another section in the budget was titled Unlocking Canada's Full Economic Potential. Is this possible with big government and the current job market?
Yeah. I mean, the thing is, the focus needs to be on improving productivity and efficiency. That's been, for a long time now. It's about how much income is generated per hour worked. And to really increase productivity, you need to increase savings and investment in the country and in the economy. And for the past, at least 15 years, our policy have been really focused on, as I said, spending more on housing and consumption. And that's really cost us a lot because now we have this record level of debt and a falling share of capital investment, CapEx spending. That's been going down as this obsession with consumption has been going up. So the public sector, governments have increased the amount of jobs by about 25% over the past decade. And that's compared with a 15% increase in private sector jobs and an outright decline in self-employment. So, that, again, it goes back to, I'm not saying all public sector jobs, all government jobs are bad, but it really is a function. The problem with them is that they tend to be paid much higher than the going rates of income in the in the private sector, and also they have a lot of benefits and pensions and things that we just don't have in the private sector. So the more that you have these embedded costs, then you're going to see those escalate year after year when you're talking about governments. And some of the public sector workers have been necessary because, for example, past government slashed them, like in areas like regulation or the Canada Revenue Agency, the amount of workers were actually slashed in the prior Conservative government. And what happened was we had this, of course, explosion in tax fraud and inability to collect revenue. And so there, to some extent, this government has been adding back those workers in a pledge to crack down on money laundering and tax evasion. So, to the extent that we're adding back workers there, that's all good. We do have a problem in that the other area is what they call the healthcare sector, where there's been a huge increase in spending and services. But I more accurately like to call that the sick care sector, because basically, people have ultimately abandoned all sort of responsibility for healthful activities and diets, and they've really adopted a whole bunch of self-destructive ones, which as the population ages, we just have no ability to keep up with that escalating cost. So, that's another area where we need to focus all of our policy efforts on incentives that can tax the bad and destructive behaviors and options and encourage, the more healthful ones. So when you look at old age security and Canada Health Transfer, as it's called, those are the largest federal budget items. So all of the, there was a bunch of, I went through the whole 450 pages of the budget. There was a lot of buzzwords for all kinds of people. They really did try and please a whole raft of folks. And yes, there's some increased spending, but ultimately it is mostly, no matter what you do on all these other fronts, the bulk of the budget is going to these old folks, so to speak. So the old age security, which is 100% people over 65, and the Canada Health Transfer, which is about 50% of those resources go to people over 65. And the reality is we have 500,000 Canadians a year turning 65, and less than 350,000 babies are being born every year. So we've got this huge bulge in the population, and we knew that was coming, Jim. Like for the last 76 years, the baby boomers started being born in 1947. We've known that this population was coming through, but we've just continually kicked the can, and we needed, we didn't address how we were going to fund this. And so now we've got this, the proverbial bulge in the python has arrived, and we really have to look at tax policy that, since we can't afford to allow the current system where everyone's abdicating responsibility and relying on drugs and sick care systems, and we've got this big, bulge of people that's taking all the resources, there's going to be nothing left for everyone else. And this is creating huge demographic problems and social imbalances all over the world, not just in Canada. But basically we need to tax things like alcohol, cigarettes, processed foods, all the things that are really cost prohibitive in terms of the full cost accounting in terms of our society, and they're diminishing our productivity. They're making people sick, which we can't afford. And we need to subsidize things like the fresh fruit, vegetables, legumes, all the things that fuel good health. Those ought to be the cheapest thing in our society, and all the very destructive things have to be a lot more expensive so that it's harder for people to purchase them. That's just in all of our best interests. And the other major factor and focus here has to be on lowering the environmental harm that we're perpetrating through all of our choices. Just one example, Jim, is microplastics. Plastics are now being found in our brains and all of our major organs. There's a whole bunch of studies showing that they're connected to the rise in mental health disorders and the infertility problems. They're finding, plastics in our reproductive organs. So all this talk about old people, not understanding why there's an epidemic of mental health disorders among young people, and why young people aren't, forming houses and having babies and pulling the economy forward. Well, there's obviously a lot of factors here, not just the fact that the old people are taking too much of the resources and have benefited from, the housing bubble to the extent that young people can't afford to have a house or have a home or even pay rent in this environment. But it's also the health impacts that we've allowed to perpetrate through subsidizing all this crappy food and allowing, microplastics to become so widespread and in everything, like leaching into our water and everything that we're doing. So obviously, again, massive cost here if you look at full cost accounting. This is all petrochemical companies behind all this that are driving a large part of the problems that are ailing us now. And so when you read the budget, unfortunately, I see their fingerprints all over trying to keep the status quo the way it is. One of the initiatives in the new budget is a focus on using federal land to increase the supply of affordable housing. And that makes sense. Like the federal government owns most of the land in the country. So that's like a no-brainer in terms of how do we, improve or increase low-cost housing. But the thing that wasn't mentioned in there at all is that we should also cover the land and government buildings in energy collection, passive energy collection like solar and wind. We've got enormous energy storage capacity in Canada thanks to our hydro resources, our water and hydro resources. And we've got this ability to collect all this free energy, and that would lower the cost. It would help pay for some of the government buildings and programs in terms of it would lower the environmental degradation and health destruction that we're seeing per unit of power. So these are the things that would greatly improve efficiency when we talk about improving productivity and taking out a lot of the dead costs that are coming with a lot of these policy decisions. And the other thing is the budget includes funding to move Canadian households away from oil heating to electric heat pumps. Again, no-brainer. If you look at the science and look at the studies, it's such a huge benefit in terms of air quality, in terms of greater efficiency of energy. But we also need to move away from natural gas as a primary heating and cooking source in the world. And certainly that wasn't mentioned at all. So that's something where we should have more incentives to help households transition off of these dirty fuels and things that are, killing us, basically air quality and health-wise, and get us into a much more sustainable thing. So the good news is there's tons of ways to do this. Another area I noticed is that in the budget, they talk a lot about support for drugs, and this again goes back to, the beneficiaries of that are primarily older people who are living longer in ill health thanks to pharmaceutical intervention. But one of the things they noted is the explosion in diabetes. And I was reading it, and it's saying, diabetes is an incurable disease. And they don't at all break down the reality that there's two types of diabetes, and type 2 diabetes is the one that's exploding, and it's mostly lifestyle-based. And it's not true to say it's incurable. It's actually reversible and has been proven to be when people change their habits in terms of what they're eating and how much they're exercising and that sort of thing. So it's, again, that's the pharmaceutical business has got its fingerprints all over the language in the budget, which is just bought and paid for by all the lobbyists that goes on, but it's not in the public's interest to be told such nonsensical things because they abdicate then our responsibility for how to improve our own health and just, want the government to buy us more drugs. Well, we're just going to go bankrupt doing that. So basically, that's another thing that really stood out.
Mentioned in the budget bond buyback programs to continue in 2024-25. What does that mean?
Well, that's just a reference really to the way that the government works with the Bank of Canada to manage its cash flow and make sure that the government has liquidity and capital needed to meet its spending and refinancing needs. So there's nothing really unusual or different there.
There's a focus on taxing cryptos in the budget. Do you think many people declare their crypto winnings or losses?
Well, given that most crypto is used for illegal purposes and money laundering, I would say no. I think that, that one of the big issues there is a lot of the so-called mainstream or reputable financial companies like Vanguard and other ETF companies and the biggest financial conglomerates in the world have gone into this crypto space with retail products, all driven by them wanting to make profits off of the retail crowd. But really it's had the impact of making it look more mainstream or conventional or legitimate, let's put it that way, because they've put these things inside these wrappers with the household, names on them that people are familiar with in terms of these issuers. And so that's attracted a lot of capital in the last year again back into that space. And so I think the government is looking at how can we capitalize because they need to increase tax dollars wherever they can. And they're saying, what assets can we attach? Because incomes are harder to tax because there's a lot of people with insufficient income right now to go around. So they're looking at how can we tax capital, and obviously that's one area.
Increasing taxes specifically on high-income earners, capital gains, and alternate minimum tax. Are these the kind of taxes that make big money look for tax-friendlier jurisdictions?
Well, they can certainly try to look for tax-friendlier jurisdictions, and based on investigations like we've seen in the past number of years, like the Panama Papers or the Cullen Commission out of BC, we know there's an enormous amount of tax avoidance and evasion going on, and has been for many years. Canada's far from unique in this. But basically, they're looking, as I said, because the average household is stretched so thin, they're trying to access those people that have capital. And that's, again, makes some sense if you think about it. The bulk of the assets are owned by people over 50. As I said, the bulk of the social and spending and health transfers is going to people over 65. So these are the people that have benefited primarily from the increase in asset prices in the past few years. And so they're trying to figure out how to get some tax dollars there to pay for their disproportionate amount of expenses and expenditures required for that cohort. So they did do that increase in the capital gain tax to 2/3 on gains over $250,000 for individuals and for all corporations. So I see that as basically looking at intergenerational wealth transfers. They're trying to equalize or move money back for these other programs to help the younger people get started. So although I'm part of the group of haves that's looking at paying more here, I'm generally in favor of it because I do understand the demographics and the big picture. But I do hope to see that the tax raised is spent on these productive pursuits, the things that will, as I say, lower our cost structure, not keep funding the really destructive stuff, lower our cost structure and make us more productive. Things like carbon capture really stood out. That's one of the areas that the government outlines in the budget, the primary area, the first thing in its list of what it wants to do on these more environmentally friendly initiatives. And carbon capture is a complete mess. That is, again, promoted by the petrochemical companies who want to keep polluting, and they say, hey, look, we don't need to reduce emissions because we can just pull them back out of the atmosphere, where, many organizations that are independent have looked at that and said, that is a complete waste of money. You're creating so many emissions trying to take the emissions out. It's just totally counterproductive. So, again, that really stood out to me as oh dear, they're going to tax more and waste it if they keep following initiatives like that.
Canada declared an emergency for lagging in economic growth. What's that about?
So, that's, I guess, back to what I mentioned here. The growth rate is barely beating in 2024 and is at risk of downside if the economy continues to erode and unemployment continues to rise. So it is an emergency because we have this productivity problem, which, again, the Deputy Governor of the Bank of Canada was making speeches on recently as well. It's been a long-standing issue, but it's getting worse, not better. And that is a problem, as I say, as the demographic shift becomes so weighty here. So the other thing is that we've got this real estate bubble, which we know has been written up for years about Canada being, a world leader in this malinvestment that's gone on in the real estate sector. And the problem is that real estate downturns, as we know, always lead the worst recessions, and historically that has been the case. So you've got this real estate downturn which is in play right now, and after years of misallocation, malallocation, it's really left us, in terms of capital, that's left us really vulnerable to financial disappointment at a time when record debt payments in the private sector are really off the charts. So the more income goes to service debt and essentially non-income producing debt, then the worse our economic outlook. It's kind of this self-defeating circle, and that makes innovation around lower waste and reducing costs all the more critical.
Do you think stock markets will continue to correct?
Well, we're certainly overdue. Nothing goes up forever. Trees don't grow to the sky. We've had a good run from last fall. Valuations are extreme on pretty much every historically relevant metric. So I'm looking at, signs of non-confirmation of some of the gains we've seen even since last fall. And the transport sector, for example, which is supposed to be confirming any rise in the industrials, has actually fallen about 8% year to date. So it's not confirming the advance in some of the larger cap companies. Banks are off about 8% in April so far, U.S. banks. And again, those financials tend to lead the credit cycle. The home building stocks are off about 10%, more than 10% year to date. And so those sectors suggest that we could see continued weakness in the broader markets. We know there's been a ton of insider selling again year to date, that they've been selling into their buyback flow, typical playbook. But that also suggests that CEOs may be concerned about the viability of the economic cycle. So it's interesting today, Tesla was breaking below 150, which is something we haven't seen in some time, and Apple was below 168. So, those companies have been disappointing and leading to the downside for a while now, but, we did talk about the Magnificent Seven there for a while, and the Magnificent Seven is now down to maybe 2 or 3 companies that have continued to sort of hold up. Amazon is just back to where it was in 2021. It's been coming off again as well. So we'll see. But nothing goes on forever, and the fiscal spending, the tax support that's come to the U.S. economy has really funneled into financial markets to a large extent as well, and I think that's been why we've seen some of the jubilance. And the question is, how long can that continue?
The gold market continues to hit all new highs. Where do you see gold heading to from here?
So this is an interesting question, because I actually think that the rally in gold has been similar to the rally in the stock market and Bitcoin. We've really seen everything, the cryptos, all of it kind of go up together on rising liquidity in the financial markets. And I think that means that they're also at risk of declining together. And so we'll see. I know a lot of people are very bullish on gold and have been talking about the fact central banks and governments have been buying more of it. But unfortunately, I've been around a long time, and I know that that's very typical behavior. Like individuals, central banks and governments tend to buy high and sell low. So the fact that they've been piling in when prices have reached, recent highs doesn't suggest to me that there's necessarily further room for a rally here, but that's pretty typical. So we'll see. But I think when you get a dash for cash, when you get the next pessimism wave catch on and have contagion, I think you're going to see forced selling across everything, including precious metals.
What is the real rate of inflation in Canada when you include food, shelter, transportation? And is the price of inflation of necessities putting the brakes on purchases of homes and autos?
Well, sure. I mean, the Canadian CPI, the official, came in at 2.9 in March. 30% of that gain was driven by a rise in rents and the cost of carrying a mortgage. So that's what they call the housing sector component, or is, as I say, driving about a third of the basket. So the federal budget was trying to deflate rents. So it's looking at how do we increase supply and reducing the number of temporary immigrants as well, because that's been acknowledged as that huge surge in the population really put a lot of pressure on rents, because they tend to be renters, not buyers, for the first several years that they, in terms of new people coming to the country. So they're talking about how do we get more supply of housing. They will be successful ultimately, because that's one thing they can certainly influence a great deal over. And that will help. But higher mortgage rates are going to continue to drive the cost of shelter, and that's something that's making it harder for the Bank of Canada. So, even if they don't increase rates from here, and even if they start to lower them, the twofold problem there is that mortgages are coming up for renewal at the sort of below 2% rates that were extremely cheap and should never have really been below 2% during the pandemic. So even if the central bank starts to cut rates, you're going to see an increase in the cost of carry as these mortgages come up for renewal. If they're not renewed at rates less than 2%, but say they're renewed at 4%, then that's still going to be a jump in the cost of carry. So it's making it, if that cost of that 30% of the CPI basket continues to have upward pressure on it, makes it harder for the Bank of Canada to lower rates in the first place. Some of the things that are helping, though, are oil is off about 12% since the September high so far, and natural gas is off about 53% since last November. So the energy component is coming in the right direction, although still oil is still relatively high. So that's complicating the equation. But the cost of automobiles has definitely been coming down because there's been less demand. Financing costs are impacting that, the same as financing costs are reducing the availability of buyers who are able to take on new homes at these levels. So that, as you have less buyers, less demand, less funding available for the home and auto sector, that will definitely help to reduce certainly the transportation component and the shelter component. But you're going to need to see a significant decline in the prices, I believe, before you're going to get that really the downtick you're looking for in terms of CPI, that people are hoping for this relief from the cost of living. And unfortunately, I don't think interest rates alone are going to be sufficient. I think it's going to have to be lower prices as well.
Is the substantial rise in interest rates finally affecting home prices, sales, and inventory?
Yeah, so for sure. The sales to listing ratio has been declining over the past year. The latest U.S. NAR data shows that the median monthly mortgage payment rose about 11% year over year in the latest data. And the average 30-year mortgage rate in the U.S. is above 7% this week. Back above 5% in Canada for fixed rates, and all the walking back of rate cut expectations that the central banks have done year to date. At the beginning of the year, everyone was very optimistic about rate cuts and that would come fast and furious and save all the over-levered people in the economy. But actually, central banks kept saying, we really can't cut quickly because we have this CPI inflation that's still a problem, and so the bond market listened. The stock market kind of ignored them for a while and rallied as it is wont to do with kind of euphoria and madness. But the bond market really heard the central banks and said, fine. So the bond market has sold off, the price of bonds has sold off, and in doing that, that's increased the cost of carry. Even as central banks have been on hold, that means that because interest rates on loans are set from the yields of the Treasury market. So as bond prices sell off, their yields go up. So you've got this tightening in the banking system, even though central banks have stayed on hold. So the spring housing market is much lower than most had anticipated. The sales of previous owned homes fell more than 4% in March, month over month, and fixed mortgage rates in Canada have also been, as I say, rising year to date. So there's been a sort of a disappointment, I think, because, again, people had unrealistic expectations of how much they were going to see a revival of buying. And I think we've got a real standoff right now between, sellers who are still hoping and dreaming they can get what they paid for, 2 years ago or 3 years ago at the market peak. And you've got buyers who are just not equipped or capable to get that kind of financing at current rates and or aren't willing to do so. And it's going to be interesting to see now. Imagine these people that have second homes and, ski chalets, cottages, things they bought during the pandemic, thinking that when they go to sell it, that the capital gain, if any, would only be 50% taxable. Well, that's going to be impacted by these new rules. So they'll be paying higher capital gains on some of those properties. So that's going to hurt in terms of interest in the space as well, I think.
Is negative amortization becoming an issue now in the Canadian real estate market?
Yeah, well, it's a big issue because it continues to be a negative for banks and for the overall economy. I mean, the fact that people are paying their mortgage monthly, but actually the debt has been increasing, not decreasing, and then they're having to refinance larger amounts at higher interest rates. Clearly, that just crimps the ability to spend on everything else in the economy. And then, this latest, again, back to the budget, they've extended the amortization period available to 30 years for new home purchases from 25. It may sound like a good idea. It's actually a bad idea, because really, if you do the math, it's quite clear that it just increases the cost of housing over time, because it means that you're paying that much longer. You're going to pay that much more interest expense. So again, it's making housing less efficient, more costly. It's going to drag on the ability of that household to spend on other things through the whole duration of that mortgage. So it is a problem, and the bank regulators are trying to increase the pressure on the banks to say, you better bring these mortgages back into line. You better get them renewed at more conventional terms, and they better get to be amortizing again, so that people are paying down the debt once more and not just increasing it. But it's easier said than done when a person doesn't have sufficient income to qualify. So it's going to be a process here for sure.
Are China's real estate problems likely causing problems in Vancouver and the rest of Canada?
Well, sure, because China was this, backstopper that came out of the 2008 financial crisis with guns a-blazing, spending a fortune on deficit financing in order to stimulate not just their own economy, but the global economy, in the hopes that would, pick up demand for exports. And it worked for a little while. But the thing is that now the Chinese government have a record 7.6% deficit to GDP. That's more than 2 times the average for emerging market economies. And they're having this housing crisis continue at home, because they also had a massive housing bubble that directed a whole bunch of capital misallocated into pushing up the price of things that the average household couldn't actually afford to live in. They were only buying them on the presumption that it was like gambling or a speculation that would make them money or improve their savings over the long term. And those prices have really been slumping now for several years. And as that continues, the sentiment of the public has shifted away from interest in speculation in housing and increasingly become discontented. Unemployment is rising there. There's a cash crunch where they're needing to repatriate funds from abroad, bring them back. So just as that deficit spending compelled all this money out into the world and pooled into places like Vancouver and Toronto and other places in the world where they were buying up properties as land banks, now you're seeing the reverse happen, where they're needing to bring capital back to pay off other obligations. And at the same time, we've also had the extension. Actually, this budget extends the federal ban on foreign buyers in Canada out to 2027 now. So they keep sort of extending that, which makes it theoretically at least more difficult for capital flows to come from abroad into Canadian real estate. And so that's that's sort of tourniquets one way that capital was inflating prices in some of the biggest cities. So as that continues and you see less inflows from abroad and you have less domestic capacity for people to buy, again, I think all of that leads to further weakness in the real estate market here.
Do you think the growth in electric vehicles will continue?
Yeah, so, a lot of people are conflating the downturn in demand for autos globally with an aversion to electric vehicles. And I think that is misunderstanding what's going on. Yes, we have a definite decline in the amount of people capable of buying vehicles, because interest rates, for new cars are over 7%, for used cars are over 11%. And this, again, comes at a time where we had record price increases in auto prices during the pandemic. So again, it's like housing. It's not just that interest rates are more back to where they were, 30 years ago, but also that prices became so unhinged and went up far too much faster than wages. And so there's a general affordability problem with vehicles. That's the first thing. The second thing, though, is that of the growth that's going on, EVs are leading the charge. So the the EVs were 15.8% of all light vehicle sales in 2023, compared with just 0.4% 10 years earlier. If you look at the chart of electric vehicles, the sales have been about doubling every 2 years. So that is a sign, and 70% of them were all battery EVs as well. So there's an S-curve adoption structure that's going on here, and it's surprising the skeptics. But if you drive an EV, as I have for several years, you will not wish to go back. I mean, the cost savings are mammoth, and for a long time, the cost of entry was very expensive, right? Because Tesla was leading the world, and it started, as many of these innovations do, it has to make a luxury product to get enough capital to then start bringing out the more affordable mainstream products. That's a very tried and true model that's happened in many sectors. But China has now, Tesla went to China, trained Chinese people how to make these electric vehicles, and they saw the technology and the battery technology. They invented they started producing it all there, and now China is becoming the world leading country in terms of EV production. And BYD and these other companies are pumping out $10,000 electric vehicles. You're seeing them all over Europe. This is just, they have as I say, the domestic economy was dependent on real estate and consumption, or trying to manifest that as the driver of the economy. Now the Chinese government has realized that's a lost leader. There's just too much weight there. And so now they're really focusing on how do we get cheap, get exports out into the world? How do we sort of save ourselves by selling goods to everyone else? And they figured out that EVs are one of the areas that are in huge demand globally. And actually, if you go back to what I was saying at the beginning, as having, to put money into things that will decrease our costs and increase our efficiency going forward, EVs are one of the areas. And Canada has actually been highlighted as having the strongest EV supply chain potential of any other country in the world, including China. So there's another area, it's due to our abundance of critical metals and our auto supply chains and our integration with the United States, the world's largest consumer. But basically, again, you're looking for areas to grow the economy and make products that the world wants. You have to look at these leading innovative technology areas that will, again, lower the environmental impact and emissions and health costs, and increase the products that people want to buy, and make it cheaper for them to operate transportation. Because ultimately that's what this does. There's an upfront cost, but then your maintenance and your fuel and everything is so much cheaper over time, and they tend to last a lot longer than ICE vehicles as well. So again, it's a way to improve efficiency and reduce cash flow over time that needs to go out. So it's a great idea in terms of one of the areas, at least, that we can focus on.
Where can people follow you?
So my daily blog is jugglingdynamite.com, and I'm also on Twitter, and I tend to do a fair amount of interviews, which you can follow me on YouTube.
Danielle, thank you so much for being on This Week in Money.
Thank you, Jim.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Coming up, Victor Adair, next on This Week in Money.
Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclico.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Victor Adair, recently retired from nearly 50 years of being in the brokerage business in British Columbia, but still very active in the markets. He's speaking to us from beautiful Parksville on Vancouver Island. Welcome back to This Week in Money.
Jim, it's always a pleasure to talk with you. Thank you for having me on.
Victor, how have the markets handled the increasing tensions between Israel and Iran this week?
Well, in a word, I think it was chaotic. Let's see, where are we? Saturday, I guess, of last week, as I was finishing up my trading desk notes, I just happened to take a breeze through Twitter before I posted them. And I saw all this coverage of, what we'd been expecting. I think on the Friday prior to the Friday close, prior to that Saturday, markets had, let's say the stock market, I think, closed on its lows. There was some anticipation that something was going to happen, but, here it goes. And it's the existential side of it. It's just kind of like, how bad can this get? Well, if you let your imagination run there, we go to World War III, right? And so here it's happening. And then by Sunday morning, everybody that was an interest rate expert last week is now a geopolitical analyst of some sort. And there's all these different views from, hey, look how superior the Israelis are. The Iron Dome protected them. Nobody got killed. Actually, people didn't even get up from the table at dinner time because, they knew there was nothing to worry about. To the other side of, the Iranians had fired 300 missiles of different kinds and all that sort of thing, and they, whatever. The market was closed. So I'm waiting, like everybody else in my business, for the markets to reopen on Sunday, and I was honestly surprised. I was short the stock market going into that weekend. I guess, in part in anticipation that all hell could break loose over the weekend. And the market opened unchanged on the Sunday afternoon. By the market, I mean the S&P futures, NASDAQ futures, that sort of thing. So I covered my position, and this is kind of an old trader's, I call it a knee-jerk reaction. If the market doesn't go down on bad news, it's probably going to go up. So I covered my short position. Then we waited virtually all week for retaliation. Again, you say, when does retaliation stop? I was sitting at my trading desk here on the West Coast around 6:30 on the Thursday night, and all of a sudden my screens just light up. Okay, what's happened? I know what's happened. I do a quick scan of Twitter, and yes, sure enough, there's explosions happening in Iran. And of course, it's clearly well past the middle of the night in that part of the country. It's 9:30 at night in New York, and the Asian markets are open. The one market that really caught my eye on Thursday night was the Mexican peso. And people that read my notes regularly know I look at the peso a lot, and there's been a huge carry trade between people borrowing for nothing in Japan and investing money in Mexican peso at 11% and making, huge gains. The peso has been the strongest currency in the world this year, trading at a 9-year high against the U.S. dollar. And it was just like, wham, the peso dropped 5% in a matter of moments. And this is a functioning of what I talk about positioning. Clearly, everybody and his dog was long peso. And, at 6 o'clock at night on the West Coast, when the Asian markets are open, there's not a lot of transactions, not a lot of depth, let's say, to the Mexican peso market. Now, it did come bouncing back, but it was just one of those other breathtaking examples, and there were a few of them. On the other side, the Swiss franc just rocketed higher, where you get an appreciation of how fast risk can happen, and by risk I mean how fast the market can move much more than you think it can in just a heartbeat. So anyway, that's that kind of plays into my thinking of risk management being much more important than having a great crystal ball. But in terms of how the markets have taken it, I think where we stand now, okay, subject to change, is that we've had a tit for tat, okay, and sort of like the score settled, and they both want to, but that is Israel and Iran, both want to back away from this thing escalating into World War III. Thank God, but at least that's how it seems right now.
The broad stock market indices in the U.S. and around the world had a powerful rally since last October, but so far this month, the indices are down. What's happening?
Yeah, the five and a half month rally we had off of the lows last October. I mean, just for a benchmark, the S&P was up almost 30%. I mean, that's been a pretty terrific rally. And it wasn't just the American markets, as you say, all around the world, stock markets were higher. We had, again, positioning. Everybody and his dog is long and even aggressively long. The rally, I should say, had initiated at the end of October last year. Prior to that, the stock market had been trading lower for 4 months on expectations that, the Fed might just continue to raise rates and make everybody miserable and so on. So at the end of October, the Treasury signaled that they were going to cut back on bond issuance, and bond yields at that time had gone to a 16-year high. And the Fed, to put it in plain language, said, okay, we're not going to raise rates any further, and we expect we're going to be cutting rates next year. That'd be 2024. Well, I've been writing in my blog for months that the market would take any indication from the Fed that they were done raising rates or would start cutting, Katie bar the door, as a green light special to buy stocks. Well, they sure did. And I mean, the rally, from my perspective, was almost unbelievable. And then, of course, we had some accelerants put in there. AI became, dandy. The Bitcoin or the whole crypto space was going up as well. We had the Magnificent Seven, and we've heard all of this stuff about the great rally we've had in the stock market. Now, I think the high was on the 1st of April. We have come off, I think, on a combination of stronger inflation reports, which would likely lead to less interest rate cuts, and a stronger economy in the U.S., which would lead to less interest rate cuts. So the stock market had gone up for a couple of months there, ignoring the fact that interest rates were looking to go up. We'd taken away, let's say, from 6 projected cuts in January, we were down to 2 or 3 by the time the market turned. So I think that's kind of the essence of it, this change in where we're going with interest rates, and then, escalating tensions in the Middle East, blah, 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 added to it. So that's, I'd say that's the big picture on what has happened. Now, lately here with the S&P down about 7%, I guess, from the highs on April 1st to the lows we had on Friday of this week. And we've seen, for instance, Tesla's down 50% from last year's high. Some of the latest darlings here, NVIDIA, the whole IA space, got hit hard going into the end of this week. So, again, positioning just so important when everybody and his dog has bought the market and it starts to fall. Some of those people are maybe out over their skis, as they say, or just, too aggressive, and they're going to have to cover. So that's, I think that's the big picture on where we're at with the stock indices.
Victor, if I can ask, there's that old saying, sell in May, go away, but everybody I've been talking to says the market always seems now to be about a month ahead of all these old sayings. October things happen in September now. Is April now the new May, and should you be taking your profits now?
Yeah, we call it seasonality, and I certainly have posted some seasonality charts in my blog over the last couple of years, from time to time. I can't personally pull a trigger on a trade, say, based just on seasonality. If it was coincident with some other things that I liked, I would do that. But and there's a fellow called Moore Research. He's down in Oregon, and he does a lot of seasonality studies, and he's still doing them. He was doing them 30 years ago. So I guess there's some persistence there. Just for me personally, I can't make a trade just based on the seasonality is what I'm saying.
Why has the U.S. dollar traded to 6-month highs this week?
The U.S. dollar actually made a low in December, and it had traded down from September to December. And during that period of time, the market was really warming up to the idea that the Fed would be cutting interest rates. Now, one of the things that's really important in the foreign exchange market is interest rate differentials. In other words, what's the base interest rate in one currency compared to the base rate in another currency? And since December, the currency markets, which sometimes are ahead of the stock and bond markets, I think come December, the currency markets started to swing to the notion that other central banks were going to cut rates sooner and possibly more than the Fed. And I think that has been kind of the key to what has happened to the dollar since December, which is the dollar index has gone up. Now, I just mentioned the Mexican peso a few minutes ago. The Mexican peso, with a 11% yield on short-term money, obviously would get preferential treatment ahead of the U.S. dollar at 5% money, and that's one of the reasons the peso was up so much. So very much short-term here, interest rate differentials. Now, there's other things. Certainly, there is what we call U.S. exceptionalism, and whether or not that is, let's say, in technology or what have you, that will draw capital to America. The recent data, the economy in the United States with unemployment at, multi-year lows, or what are we at, 3.8 or something percent, strong economy, and, the States, or I should say North America really, is in a unique position with respect to fossil fuels. We are self-sufficient in fossil fuels, and it's cheap. Now, particularly natural gas, and I keep writing about natural gas in my notes. I just see natural gas. I mean, I think it's going to get used more widely, and it gives North America a huge competitive advantage over other countries in terms of, create the price of electricity, say, if you're using it to create electricity. Or I think the real win would be if we had, and this is real big picture stuff, but if we had transportation vehicles, even cars, switching to natural gas as a fuel. There is the safe haven aspect of the United States. When people are worried around the world, the United States in particular looks like a good place to put your money. Militarily, nobody comes close. No matter if people worry about China or Russia or whatever. I mean, they've got the strongest military. They end up, the United States is also the world's reserve currency, and that creates privileges in and of itself. So you're just asking me, why is the U.S. dollar so strong? And those are some of the reasons. The Canadian dollar here is at a 6-month low, and that is, as I often say, the value of the Canadian dollar is usually determined more by things that are happening outside of Canada than domestic issues inside Canada. The market, let's say we had a political an election, and somebody that was bad for the economy was elected and became the new prime minister in Canada. Oh, geez, we already have that. I forgot. You'd think that would be bad news for the Canada. Well, yeah, it would be, but it could get overshadowed by what was happening to the euro-US dollar rate, which would impact the Canadian dollar. So the Canadian dollar kind of follows the euro around, I should say the euro relative to the U.S. Let me say it a different way. If the U.S. is up against most currencies, it's up against Canada and vice versa.
Gold is at an all-time high despite higher interest rates and the strong U.S. dollar. Why is that? And do you expect gold to keep going up?
Yeah, gold has been a bit of a puzzle to me, and I mean, I really have looked into this. I've traded gold for over 50 years. There's Ross Norman, who is a gold analyst in London, who I've known for, I guess I first met him 30 years ago or so. And he came out with a theory a couple of weeks ago, I think it was. He's saying that there has been a massive amount of call option buying in the over-the-counter markets in gold. In other words, some hedge fund or a group of hedge funds have been aggressively buying gold, perhaps in anticipation of, any number of the things that people are bullish, around gold. Whatever. And there's some credence to that, because when I look at the COMEX market in North America here, the open interest, the volumes, the participation rate, that sort of thing, positioning has been rather static for the last 6 weeks, 2 months, that sort of thing. Like there's no footprints there that somebody's in size in the market. So there is that. Certainly everybody knows that central banks are buying more gold than they used to be, particularly since the Russian invasion of Ukraine and the confiscation or the freezing or whatever of some Russian assets by Western countries. And, that leads central banks to not want to have that kind of U.S. dollar exposure. But I've thought, and I've seen that the differential between the price of gold traded in Singapore and London and New York is different. I think that the buying by Chinese retail buyers hasn't got as much respect or attention as I think is warranted. And I can picture why, let's say, reasonably wealthy Chinese would want to buy gold and maybe, try to get it out of the country or whatever, just so that they, looking around at their alternatives, gold looks pretty attractive. So, and the gold market is trading with greater volatility. I mean, I had some charts up the last couple of weeks on gold vol, and I mean, it's off the charts, really, to be expected. I mean, we're seeing price ranges here of easily $50 a day. So it's not your grandmother's gold market, that's for sure.
Well, if Granny went into Costco or Walmart now, you can buy an ounce of gold. They're selling little gold bars, just
right,
like their chocolate bars. What kind of an impact is that going to have on the gold market?
Well, Costco's apparently selling between $100 million and $200 million worth of gold a month. Now, what seems to happen is when they get the gold bars in, they go off the shelves immediately. Word gets around and away they go. So they could be selling more if they could get more. And I was around for the super bull market that we had. I was trading futures in the late 70s and the early 80s, and I remember going down to the Bank of Nova Scotia and seeing a lineup of people outside the bank going around the corner. I mean, there must have been a couple of hundred people lined up there to go in to buy gold. And, that's sort of the gold rally that boomers remember that happened, 45 years ago. So, Jimmy, something we didn't cover actually was, and I think this is kind of important, is how the markets have changed, how they're pricing inflation. And, we had the inflation spike after or during really COVID, and it was a couple of things. On the one hand, there were supply shortages or bottlenecks or whatever, and you couldn't get stuff, computer chips and potato chips and God knows toilet paper at one point, right? And then there was this massive fiscal stimulus and to try to, compensate people that had to stay home, couldn't go to work and all that kind of thing, good intentions. But I think that kind of opened the government's eyes to, they can spend as much money as they want without having to collect all that money in taxes. So they call it deficit spending. You're spending more than you take in as a government, and voters say, yeah, okay, I like that, and they keep voting it. And what that ultimately does, of course, it cheapens the purchasing power of the currency, and then ultimately that creates inflation, because if, you've got $5 in your pocket and you can't buy as much as you used to, that's what inflation is. So now you need to have 10, so you got to get, a raise. And if you're a business, you got to sell your products for more because your input costs are higher and so on. So I think we're into this cycle of inflation. And, the central banks have raised interest rates to try to keep it down. And I don't think they're getting the job done. I think people understand that the things that they want to buy, that they need to buy, the cost of those things is going up much more than what the CPI is. And, there is this idea that if they get the interest rates up high enough that will kill inflation. There is a wonderful counter-argument that goes with this. And people that are my age and that have got some savings in the bank are going to go, hey, holy mackerel, I can actually get paid some interest on my money for the first time in a decade and a half. And now you've got some income there that, you haven't been used to. And that gives you more money to go out and spend things. So higher interest rates, in a way, actually help stimulate inflation. Anyway, I just think that there's two sides to the story. There's people that think inflation is going to go down because of blah, blah, blah. And I'm on the other side of the story that says the root of this inflation is not just, supply shortages and so on. The root of this is government deficit spending, and interest rates are going to rise, and as the value of the currency depreciates, that's one of the things that motivates people to buy gold, I guess, which is what talking about gold triggered that rant.
In your weekly trading desk notes at victoradair.ca, you usually have a section called On My Radar, where you write about trades that you're considering. Well, what's on your radar today? Vasily, one ping and one ping only.
Well, yeah. What's on my radar kind of means is I'm watching a market, and I wrote about one particularly last week, the Mexican peso. And the question I posed was, is the peso too strong for Mexico? ? And I thought, I think it is. It's at a 9-year high. Maybe it's harder for them to sell their products into the United States, clearly their biggest market, although when you look at terms of trade, that's not a worry. But what's really exacerbated the rise in the peso has been this carry trade, where people have been buying it because the interest rates are so high. Well, 5%, I should say 11% short-term interest rates in Mexico, but the inflation rate is about 4.5%. So there's definitely room there for the Bank of Mexico to lower their interest rates. And if that happens, then the carry trade maybe doesn't work as well anymore, and people who've got it on have to sell it, and you could have kind of a cascade effect and have the peso come down. So that's like, I'm just describing what I call a setup that I saw and wrote about last week. So a setup could be a chart pattern. It could have something to do with correlations between different markets. I pay a lot of attention to positioning. Right now, one of the positioning things I'm looking at is the Swiss franc. The open interest, that's the number of contracts we have on the Chicago mercantile market in Swiss francs, is greater than ever before. And the positioning of speculators, that's large and small, and I see small speculators are right up to their eyebrows in being long, I should say short of the Swiss franc, as the Swiss franc hit virtually all-time highs in December of last year and has had this steep fall. So positioning is everybody and his dog is on the short side of the Swiss franc. And, I think the Swiss National Bank has been happy to see the Swiss franc fall because it was harder for manufacturers in Switzerland to sell their products. Swiss watches is the first thing that comes to mind when the franc is so strong. So positioning is another thing I watch for. Reaction to news, and this is a classic. And like I just mentioned about the stock market on Sunday afternoon, I thought we had some pretty bad news. The World War III just started. The market opens at 3 o'clock on Pacific time, and stock market's unchanged. And I go, whoa, I can't stay short here. I got to get out. So, reaction to the news, fundamental analysis, carry trades, interest rate differentials, all that kind of stuff that I look at. And then I sort of wait for some reason to pull a trigger on a trade. So that could be, again, a reaction to a news event. Right now, I think that if the Swiss franc, for instance, started to rally, a lot of those people who are short might have some stops above the market, or they might want to just say, hey, I want to take my profits or whatever. So you could get into a situation where relatively there's nothing but buyers in the market. Nobody wants to be a seller. Anybody that does want to be a seller says, hey, I wait, I think prices can go higher and I can get a better price. So that's a classic kind of a setup for me, and that's the sort of thing I write about on the radar section of my notes.
Victor, thank you so much for being on This Week in Money.
Jim, it's always a pleasure. I mean, there's just, it's kind of hard to know what to leave out. There's so much going on in the market these days. But I appreciate the opportunity to talk with you.
My guest has been Victor Adair, who has just recently retired from nearly 50 years of being in the brokerage business. He was speaking to us from Parksville, British Columbia. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Danielle Park, and Victor Adair, and thank you for listening. If you have any questions for the show or our guests, you can send them to info@howstreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen.